It's Matt Santagapita from the Santa Sells Houses team, and this is another episode of our Money Market Update. So I'm going to jump straight into the numbers, and then I'm going to compare some of the numbers that we are seeing right now to what they were a year ago and 2 years ago, to give people some insight to, why we're maybe feeling what we're feeling as sellers and buyers. So this past week in the City of London, we saw new listings coming in at 223, conditionals at 43, and solds at 61. Now, consistent theme that we've been seeing now for, call it 4 to 6 weeks is dropping sales. I think they've kind of leveled out now. So I think we're going to kind of probably hover around these numbers for the next little bit, probably till at least we get a good snowfall. But what are people feeling? I mean, I think a lot of sellers are kind of wondering what's going on in the market because we're seeing a lot of homes not selling. And I wanted to put this into context to give people an idea of, how much the market has changed. So this same time last year, we actually saw twice as many homes selling. So for full sold, so when we say sold, that means sold firm. When we say conditional, obviously it's sold conditional upon, let's say, finance, a home inspection, property selling. So anyways, I'm going to focus on sold data. So this past week in the City of London, we saw 61 deals go firm. A year ago this time, that was actually double. So we were just over 100, 120 range. And then 2 years ago, we were at the 150 to 160 range. So sales are dropping significantly. And why are they dropping? They are dropping because housing prices are not dropping fast enough to accommodate for the payment that people can afford. That's the easiest explanation. And so, which is, I don't know, a good thing, a bad thing. It depends on how you want to look at it. I think obviously housing prices dropping significantly would be a bad thing. However, until we can get payments stabilized to a more reasonable monthly amount, I think this is the reality of the market. I don't think that we are going to see sales increase that much until the payments can drop. And the easiest way to do that is if rates drop. The second easiest way to do that would be if we have the ability to extend amortization periods. So right now, call it a high ratio mortgage. So that is less than 20% down. You are sticking at an amortization period of maximum of 25 years. If you put 20% or more down, you can go to a 30-year amortization, which your payment drops. If they were to change amortization periods and, let's say, allow for anybody to do a 30, a 35, a 40, even a 50-year amortization, the monthly payment drops. And it drops enough for people to afford the more expensive homes, which that's what we have the most inventory of. And by most expensive homes, call it everything from 800,000 and up. Those are the most expensive homes in the London area. Realistically, let's just say 1,000 and up, or sorry, not 1,000, 1 million and above. I would bet it's probably at least half the market. And it's just not affordable to the average household. Anyways, that's my 2 cents. Again, it's Matt Santagapita from the Santa Sells Houses team. This has been another episode of our Money Market Update.